Good afternoon, and welcome to Juniper Research's Top 10 Fintech Predictions for 2020 webinar. I'm Nick Maynard, Lead Analyst at Juniper Research, and with me today I have Lead Analyst James Moore and Research Analyst Susanna Hampton. Now, what we're going to go through on the webinar for today is, firstly, we'll have a bit about Juniper Research and how we've arrived at these predictions. Then we'll go through the top 10 fintech trends themselves, and then we'll finish off with a Q&A session. So to begin with, here's a brief introduction to Juniper Research and our top 10 fintech predictions. So Juniper Research specializes in identifying and appraising new high-growth market sectors within the digital ecosystem, with a focus on the fintech and payments market. We provide market research and content across over 50 different technology markets. These research reports form the basis on which our expert analysts make these predictions. So for the webinar today, this is our first year of publishing a set of specific fintech suggestions, but it follows 10 years of publishing a general technology trends list. Now, in order to form the list, we look at a number of metrics. Firstly, we look at what legislative changes are planned, what products have recently launched or are planned for launch, and which technologies are anticipated to have the highest disruptive potential. Now, our analyst team then whittles this pretty long list down to a much shorter list of potential trends, and we then rank them on their overall likely impact in 2020, which gives us our set of top 10 fintech predictions. Now, for this webinar, we've put together a couple of slides on each of the trends. And for each of these trends, we'll be following the same pattern. We'll be exploring four really key aspects to it. Now, firstly, what's the opportunity? Then why it's going to happen in 2020? Who will it benefit? And lastly, what's the prediction we're making? And we've also included the title of any existing Juniper Research reports where we can. Also, when my colleagues and I have run through the list in reverse order, we'll be answering a few of your questions. Now, you should see on the bottom right of your screen, you have a chat box, so you can send your questions to us while the webinar's in progress. Now, please use that box to do so, and any questions we can't answer during the webinar, we will answer afterwards via email. So, that's the introduction. What does the next year hold in store? So to begin with, here's number 10, which is the momentum behind instant payment systems will grow, with international operability between schemes being a crucial element. So in recent months, the concept of instant payments has become really highly important. In both the consumer and B2B payments areas, settlement times have really been a challenge. Now, the term instant payments refers to the ability to make payments within a matter of seconds, as this speed of settlement would be highly beneficial to parties throughout that payments landscape. Instant payments have become an essential target for financial institutions and regulators alike, and that's been driven by success stories from early deployments. So SEPA, the single euro payments area scheme in the EU, has brought down settlement times significantly, and the SEPA Instant Credit Transfer Scheme has reduced them further. Under SEPA Instant, the payments will be received in a maximum of 10 seconds, which is dramatically faster than traditional methods. 2,079 payment service providers have already joined the SEPA Instant scheme, which is 51% of European payment service providers, with 5.53% of SEPA transfers in Q4 2019 being via this instant method. However, much more work needs to be done to achieve instant payments across the board. The US Federal Reserve has announced that it is developing real-time payment service FedNow, but this will not launch until 2021. The service will process individual credit transfers valued at $25,000 or less within seconds. So why 2020? With the example that SEPA Instant Credit has set, momentum is rapidly building in instant payments, meaning that the FedNow service is slightly behind the curve in terms of developments. Vendors such as Swift are releasing new standards such as GPI, which will significantly reduce payment times by delivering payments in seconds. In trials involving Singapore's FAST scheme, GPI saw payments across continents settling within 25 seconds, with the fastest only taking 13 seconds. ISO 20022 is a bank payment messaging standard which is beginning to be adopted globally by regulators and institutions, which will harmonize payments messaging internationally and will make the implementation of cross-border schemes much easier. And the FedNow service will be based on those standards. So we've seen a lot how the momentum is building. Now, who are these instant payment schemes going to benefit? So to start with, businesses are going to benefit from a vast improvement in the speed of B2B payments. Faster settlement in seconds will transform the current way accounts processes work. Now, this is going to impact the Americas the most. And as you can see with the graph on the right, the Americas accounts for the largest proportion of B2B cross-border payments globally. Now, consumers are already going to benefit from this as well. Instant payments will mean a much faster transaction speed for P2P payments, and that's particularly important for remittance senders. And again, that will be highly important in the Americas, with US-Mexico being a massively important remittance corridor. Finally, we predict that the adoption of instant payment schemes will accelerate, focusing on international interoperability in 2020. This process will be enabled by the greater standardization of payments messaging, which is being driven by the adoption of ISO 20022. And these changes in the market will mean that by the time FedNow is introduced in the US, many other areas will have already adopted equivalent schemes. Now, for this reason, the US Federal Reserve should really focus on beginning early trials of FedNow as soon as it can, so in order for it not to be left behind. For more information, we have reports in both the B2B money transfer and digital money transfer and remittance areas, which are accessible on our website and are linked for you below. Now, on to number 9, which is that digital banks will rebundle the services they offer using open banking. So, in recent years, digital-only banks have emerged in numerous markets, focusing on disrupting single elements of the banking experience. Now, by this, we mean that digital-only banks have had a very specific USP, which has been tackling one element in the banking bundle. Now, for that, we mean, for example, on providing AI personal financial management or a low-cost international travel solution. This approach has meant that digital banks have gained significant support. It also means, however, that digital-only banks have been necessarily limited in scope and not widely utilized as users' main accounts. But open banking is enabling a change to this. In order to succeed and become the accounts of choice for users, rather than a secondary account, digital-only banks need to offer full bundles of services to users, such as insurance, mortgages, credit, and others. Open banking APIs mean that banks do not necessarily have to offer these other services themselves, but they can be added from third parties via those APIs, significantly increasing the appeal of their services without having to do an enormous amount of work themselves. Starling Bank in the UK is an example of an API-based marketplace for personal and business customers, and that offers further financial services via an app-based store. Now, that increases Starling's value proposition, but it doesn't mean that they have to undertake further work themselves, other than creating the API and checking that those connections are secure. Now, why is this going to happen in 2020? Firstly, open banking as a concept has become relatively well established in Europe due to the changes under PSD2, meaning that customers are more open to shared access, with APIs being fairly broadly available now. Another significant factor in Europe is that competition has increased for digital-only banks. Traditional banks have begun to launch digital-only brands of their own, such as Bo from NatWest, which provides more competition for digital-only brands. Additionally, fintechs have emerged that offer banking-related services, such as financial management in numerous areas or insurance. But in many cases, these fintechs lack the access they need to users through their bank accounts. Now, there's a wealth of choice in these services, but many have relied on viral marketing or social media campaigns to promote standalone apps, which have fairly limited reach. So who's going to gain from this trend? Firstly, the digital-only banks themselves will benefit. Having more services for them to offer will make them pretty much more compelling to the users. These banks have struggled to convince users to use these accounts as their primary account where their wages are paid in. And by increasing that crucial value proposition, users are likely to change that stance. It also means that the bank can develop additional sources of revenue by, in effect, acting as a broker for further financial services. Fintechs who offer additional services will also benefit from this development. Being able to offer services via APIs will give them more access to users and will broaden their addressable market significantly. And for users, it increases the value proposition of having a digital-only bank significantly and reduces the amount of effort required in accessing financial services. This will lead to higher digital engagement for the user beyond simple banking. Ultimately, we anticipate that digital-only banks leveraging open banking APIs will evolve into full bundle offerings, which will fundamentally increase their value proposition, and their competitiveness will also increase. And that will create several other effects. There'll be additional impetus for digital transformation at traditional banks as they react to this increased competitiveness. And that will involve traditional banks offering improved app experiences with enhanced features, as well as launching bank-backed digital-only brands that can attract new users from different demographic groups. These changes will also result in significantly more traction in the digital-only banking space, with users moving to use these accounts for all of their banking. Now, this will allow digital-only banks to increase their average revenues per account holder, which will increase their revenues and crucially may unlock a path to profitability. And with that, we're on to number 9, which is that Latin America will emerge in the next year as a crucial payments battleground. So what's the opportunity for the payments market in Latin America? Really, this trend begins with what's happening in developed markets. Traditional payments companies are facing pretty much lower growth in developed markets, as those digital methods are starting to reach saturation in some areas, and growth is not nearly as strong as it once was. That's led to a number of changes already throughout the industry. One such change we're seeing has been the recent trend of consolidations and acquisitions, such as Visa buying Plaid. The most important effect this lack of growth is having, however, is that numerous players throughout the financial ecosystem are looking to emerging markets for future growth, in particular Latin America. Now, why Latin America? Latin America is a particularly attractive market, as while there's a lot of room for expansion, there's already some infrastructure in place. And there's really an established credit culture based on credit cards, as well as relatively high rates of banked individuals. This means that digital payment solutions are entirely plausible to roll out in the area almost immediately, putting it ahead of other developing markets such as Africa. There is also a growing e-commerce market in Latin America, which makes a really tempting target for partnerships. If payments vendors can tap into this demand, then they'll access powerful revenue streams. Now, why is this going to happen in 2020? So 2019 was really all about setting the stage for this. Latin America saw a gradual expansion of partnerships, such as PayPal partnering with Mercado Libre. 2020 will see these partnerships intensify and begin to deliver results at scale. Other vendors will follow this example and agree further partnerships, as well as make acquisitions in the area. In particular, card networks will be major drivers of innovation, with recent months showing that acquisitions are accelerating. And as well, you've got the example of Nubank in Brazil, which has had a lot of success. And that shows the potential that digital solutions can have. And digital wallet services will be keen to exploit that in particular. And that demonstrates that in 2020, the market is very much ready for digital disruption. So again, who's going to benefit from this? Now, the main gainers from this will be the payments companies. In particular, card networks and digital wallet providers will benefit from increased user bases, as well as diversified revenue streams. If these vendors move quickly to leverage the potential they have in this market, they'll be able to gain a significant early mover advantage. However, in order to access these benefits, companies may have to change their fundamental approaches. For example, a payments vendor previously committed to contactless may find that QR is a more appropriate approach in emerging markets, and that'll require a significant level of agility for some of these vendors. Users in Latin America will also benefit, as they'll be given much more choice and access to new payment solutions. This will increase the level of overall digital engagement, and that can be a benefit for users who have not previously engaged with those. Through partnerships with established international vendors as well, local payments companies will benefit, as they'll be able to scale in a quicker way, which will be really beneficial for them. Initially, we'll probably see more partnerships like PayPal and Mercado Libre, and these will drive digital usage in e-commerce. This could be partnerships between e-commerce vendors and retailers, or it could be partnerships with payment companies and local payment companies. This really could happen in any of those ways. Ultimately, payments companies will begin to look farther afield for their future revenues, into markets such as Africa as well. However, those markets are going to require a bit of a longer-term approach on the behalf of those companies. And these areas will require a lot more lead time for building that infrastructure, which will be crucial. Payments providers will likely have to adjust their basic propositions to reach scale in those markets in a way that has not really previously been required. And for further information, please look at our digital commerce regional analysis research, which gives you much more details on regional trends in payments. And now over to Susanna for number 7, which is QR payments to reach scale in emerging markets.
Thank you, Nick. So QR payments have to now been almost exclusive to China, and at this point they've reached scale. The success of Alipay and WeChat Pay in these markets has meant that QR payments have seen transaction values reach $2 trillion in 2019. QR payments have also seen success in the Indian subcontinent, and transaction values here have grown from around $1.7 billion in 2016 to $36 billion in 2019. So Juniper Research anticipates that 2020 will see further rollouts of QR in emerging economies, with the likes of Alipay and WeChat Pay rolling out beyond the Chinese market. And we see that emerging markets are facing the same challenges that China saw a decade or so ago. That is, their economies are expanding without necessarily having the infrastructure to deal with this growing payments landscape. In markets such as these, there's a high proportion of unbanked individuals and also a low penetration of point-of-sale terminals. And this means that there's pretty limited potential for card payments to grow without vast infrastructure spending. Crucially, though, smartphone penetration is high in these markets and internet connectivity is improving, and this means that QR payments have a very high growth potential here. In addition, China has been making significant investments in emerging economies in recent years, particularly across parts of Africa. And according to the China Investment Global Tracker, China invested $295 billion across a number of sectors in sub-Saharan Africa between 2005 and 2018, with the Chinese president pledging to invest a further $60 billion in the region. So we at Juniper believe that this continuing investment activity will help to drive the deployment of QR payments in these emerging markets. The two biggest QR payment providers in China, that's Alipay and WeChat Pay, are rolling out in several markets, including South Africa, Thailand, Philippines, and also Malaysia. Additionally, traditional payment vendors in Western markets are looking to expand their offerings and geographical scope through QR. For example, MasterCard and Visa have already introduced QR payments through MasterCard Pass and M-Visa in several African countries, and Visa have also extended this across Asia Pacific too. This sort of activity will only accelerate as vendors look to QR to generate new revenue streams outside of their traditional home markets. So what will the major benefits be and who will they benefit? So the deployment of QR payments outside of China and India will provide major benefits here. QR code payments are easy and inexpensive to set up and use, compared with NFC-based payments such as contactless cards and OEM Pay. And this is because they don't need a fixed point-of-sale infrastructure in the same way as cards do. The ability to roll out services using smartphones also significantly increases the scale that these services are going to be able to reach in the short term. QR codes also have a broader appeal in that they can be used to link to e-commerce payments as well. Another key consideration is that smartphone penetration is rising rapidly in these emerging markets, and we see that Africa and Middle East penetration will reach over 50% of the population by 2024. And this is going to be a key enabler of digital payments in the region. And QR therefore will be an essential way to address this market. As such, we see that there's going to be significant growth in this region, with a total value of QR retail transactions in Africa and Middle East reaching almost $28 billion in 2020. So as well as the cost of cash handling, cash is limited in the role it can play in e-commerce. QR doesn't have any of these limitations and is likely to play a key role in the displacement of cash in these emerging economies, as well as being a key tool for e-commerce payments. As a result, there will be strong competition between payments vendors in the market, with the likes of Visa and MasterCard battling QR specialists such as Alipay and WeChat Pay. But while these Chinese solutions look primed for success, it might just be that QR rollouts in these markets will be regulator-driven. In this case, regulators might just choose established card networks to develop national QR code payment standards. Now I'm going to hand over to my colleague James, and he's going to talk a bit about challenger bank consolidation.
Thank you, Susanna. Challenger banks have been an important new element in the financial services ecosystem in the last few years, providing digital services that traditional players have typically been quite slow to deploy or quite piecemeal in how they've done it. However, despite 9 challenger banks reaching unicorn status in over $1 billion of funding and reaching millions of customers worldwide, the outlook for many of these banks is a little shaky at the moment. Many of these banks, despite some success in gaining user numbers, have struggled to convert their growth into productivity. The Challenger Bank N26 crystallized this sentiment when their chief financial officer stated that profitability was not one of the bank's core metrics, which caused quite a few people to ask questions. And with the idea of the Uber of banking still holding sway among challenger banks and fintechs, this attitude of prioritizing growth over profitability is one that's very prevalent in the space. And in addition, these banks have typically expanded into many different countries very rapidly, rather than attempting to reach a large scale in their first few initial markets and get the economies of scale going to the point where they can generate profitability. And these banks have also focused on disrupting a single element in the banking experience rather than offering a wide range of features. So the typical avenues for monetizing their existing users have been quite low. This single element has also often been at the checking or debit account, which is a relatively low margin thing compared to a lot of other banking products. And this means that without fundamental changes or expansion of the business models that are employed by these challenger banks, the route to profitability looks quite challenging. Digital-only and challenger banks may also be attempting to a different strategy that isn't entirely focused around profitability that will also drive consolidation in the market. Visa's recent acquisition of Plaid and Payworks shows that for many fintech firms, being acquired is actually proving to be a possible strategy to please investors and maintain their position in the market. We expect that more fintechs and challenger banks will be acquired in the coming years, which could also function as a way for interested technology companies to gain a foothold in financial markets, as well as for larger banks to continue to diversify their offerings. We expect 2020 to be a key year for this because of a broader trend in the technology investment market, that finding investors with deep enough pockets to fund profitless growth is becoming harder for everyone in the space, with some return on investment early on being essential. This change in investor behavior can be seen particularly in the difficulties that WeWork encountered last year. And traditional banks are looking to augment their portfolio with digital offerings like RBS's Bow. That's made the most noise recently in the UK. And not only are they launching digital-only brands, but traditional banks are also transforming their own offerings through both open banking connectivity and much improved digital features like personal financial management and automated saving programs, that sort of thing. This ultimately means that challenger and digital-only banks will be squeezed on at least two important fronts: that they must boost their differentiation versus traditional banks to ensure that they remain compelling, and they also need to focus on achieving profitability regardless of their overall user growth, or they will struggle to survive for very long. This growth-only approach we believe will ultimately make investors back away from the challenger bank space to an extent, which will only accelerate as some digital banks begin to burn through their investor cash and need to raise additional funding rounds this year without anything necessarily to show for it. This means that we will expect several challenger bank exits this year, and opportune acquisitions by large financial institutions, as well as some non-finance players looking to monetize their existing users in new ways by using some of the technology that challenge banks have developed. And we're now on to our next trend, which is that 3D Secure 2 will enforce de facto strong consumer authentication implementation across many digital payment channels. And the 3D Secure standard is being retired this year and being replaced with 3D Secure 2, which implements default strong consumer authentication, or SCA, as part of its protocols. And with the deadline for the EU's second Payment Services Directive, their strong consumer authentication requirements being extended to the 31st of December this year across the EU, thanks largely to the space being unprepared for it. We'll see more and more e-commerce merchants migrate over to the new standards this year to comply with that amended deadline. And although as several digital payment platforms now offer systems that integrate 3D Secure 2, the biggest lag will now come from acquirer banks, who will need to adjust their systems to integrate with a wider variety of APIs that these platforms offer in order to ensure a smooth consumer journey. And we previously saw that native mobile apps will lead the way in second factor of consumer authentication. And these standards mean that it will become easier for browser-based commerce to have these measures in place as well, where there's the hardware features to support it. This will be an opportunity for payment platforms to extend their browser-based offerings into the domain of authentication and provide more methods to deliver based on those sorts of new requirements. This will then lay the technical groundwork for desktop e-commerce authentication to expand into areas like facial recognition, although we expect mobile to be the biggest space for this because of the ubiquity of selfie cameras and the increasing levels of other biometric technologies which aren't really prevalent on desktop at this stage. And 3D Secure 2 and the SCA standards will serve to make transactions more secure, which means that we will ultimately see lower costs related to fraud and fraud insurance. But in the meantime, the implementation of this will lead to some increased costs and time spent deploying software to comply with the new standards. We expect Q3 of 2020 to be the biggest time of transition for this, as many e-commerce providers are not yet ready, but they won't want to push any changes through in the fourth quarter in case any bugs in the last minute rollout deny them any revenue over the busy holiday period. They won't want to risk that. So any implementations will generally be in place before then in order to comply with the deadline. Subsequent versions of the standard have all been aimed at making the consumer journey more convenient, and as a result, we expect the majority of merchants that are moving over this year to deploy 3D Secure 2.1 or 2.2, which have focused on allowing a smoother implementation of the exemptions to the strong consumer authentication requirements, such as allowing smaller transaction amounts to be exempt from those authentications. So it makes the whole journey that much easier for those smaller amounts, rather than just having a blanket, you must have the authentication regardless of the transaction value, which makes the journey smoother. And given this, we will expect high-value card-not-present fraud to decline quite a bit. And so we'll see an uptick in the volume of lower-value fraud transactions as fraudsters limit the exemptions that are coming into place in order to avoid the stricter forms of authentication. And this will also have the effect of shifting fraud to non-material forms of purchase, such as mobile top-up and digital subscriptions, where they can be adjusted to fall under that threshold more easily than with physical goods. And now back to Nick for trend number 4, which is talking about how Facebook Pay is expected to gain momentum this year.
Great. Thank you, James, for that. So really what we're talking about here is what is the opportunity for Facebook Pay? So in November 2019, Facebook announced that it was consolidating payments across its brands with Facebook Pay. And Facebook Pay is designed to provide a consistent and unified payment experience across Facebook. So that includes the apps such as Facebook, Messenger, Instagram, and WhatsApp, which will replace several different payment solutions which have been integrated into those apps. Now, this is despite the near collapse of Libra, which Juniper Research predicts. So despite that, Juniper Research predicts that Facebook Pay will become an important payments channel. Now, firstly, let's give a bit of background on this. The increased focus on payments by Facebook is a little bit surprising, I think, given the recent regulatory difficulties that Facebook has encountered with the Libra project. In particular, scrutiny for 2 areas has been really, really intense. Firstly, in the US, and secondly, in the EU. And this scrutiny has meant that key payment partners in that project, such as MasterCard, Visa, Stripe, and PayPal, have all withdrawn. And this really, all we've seen is just limited enthusiasm from global regulators. And that's left Facebook pretty isolated in that initiative. However, that doesn't mean that Facebook doesn't have a role in the payments ecosystem. Libra has been very controversial, partly due to its cryptocurrency origins. And regulators and governments have seen that as a bit of a threat to their own currencies. Facebook Pay, however, doesn't involve cryptocurrency, so it's a bit better insulated from that criticism. Although concerns around data privacy, given that Facebook are involved, will persist and must be handled effectively for this to succeed. And Facebook is high potential because it touches e-commerce and payments in several areas. WhatsApp and Instagram in particular have high potential for P2P payments and marketplace payments respectively, which Facebook will be keen to exploit. So why is all this going to happen in 2020? So given the response Libra has received, Facebook will be urgently seeking to regain its momentum in payments following this announcement of the initiative. And this means it's going to focus heavily on rolling out features and monetizing these services as soon as it possibly can. WhatsApp and Facebook Messenger are extremely popular chat apps, and they have potential for P2P and merchant payments. There's also been the recent launch of WhatsApp for Business, as well as the existing business presence on Messenger, which makes these important payment channels potentially. Additionally, Instagram has become pretty essential to e-commerce campaigns, with massive potential benefits of adding payment features to this, including checkout through Instagram and a more direct monetization of influencers. And this is particularly important given how at present influencers are used to advertise, but they link to other sites for e-commerce, which really takes that payment away from Facebook. Integrating payments into the apps will give Facebook more control over that process, which will be a major benefit to them. So given that, it's really not a surprise that this move is going to benefit Facebook. Facebook traditionally has gained much of its revenues from its advertising business, but it's struggled to gain a significant proportion of its revenues elsewhere. By entering the payments ecosystem and leveraging its presence in various high potential areas, it can generate a significant additional revenue stream, and that would be hugely important for them. The second group to benefit will be users. While this consolidation is clearly in Facebook's interests, users will also benefit from having a new convenient payment method for multiple use cases. Facebook's potential offering in P2P payments can be highly positive, with social payments working well in other areas. And this has really become proven with apps such as Venmo and Zelle based on the social payments element, and they've both achieved success. Users are also likely to have the ability to pay merchants via Facebook Pay, which would be a convenient option. And we also have the feature of Facebook Marketplace, which allows local sales of goods, and that could be transformed with the addition of payments. And if that addition happens, users will have a far easier way to pay for purchases in a challenge to other local selling services. Now, the crucial issue that has to be balanced very carefully is user privacy. Facebook has previously been embroiled in scandal with the Cambridge Analytica episode. This has meant that regulators have taken a more of a front seat in scrutinizing Facebook's operations, and it will have to carefully manage this in order to harness its full potential in the payments ecosystem. Despite these challenges, however, Juniper Research predicts that Facebook Pay will become a significant payments player, and it will tap into this social payments trend that has been building for a number of years. And this is going to generate three primary effects. The first is going to be that valuable additional revenue stream for Facebook. The second will be increased competition for P2P payments vendors, and these players will have to reevaluate their strategies to ensure that they're well placed in this changing market. And the third will be these additional security and privacy concerns around Facebook's greater involvement in payments. But Facebook will move to mitigate these concerns really by utilizing a third-party payment gateway to power its payment services, which will shift some of the liability. Now, it's over to James for number 3, which is all about tech firms moving into banking.
Thank you, Nick. Tech firms like Apple, Google, and Samsung have been providing payment services for several years now, and a number of trends have started to coalesce to accelerate their movement into financial services in general. Chief among these is a decreasing financial brand loyalty, primarily thanks to open banking, which has loosened the hold that banks have on their customers' data, as well as many countries also mandating a streamlined switching service for banks to mean that people can move banks much more easily. Digital-only banks have also emerged that have offered disruptive features to users and have challenged the established banking industry and caused quite a few feathers to be ruffled. As such, banks have a more limited ability now to retain their users compared to what they're traditionally used to. By contrast, technology companies have had much more success in developing closed ecosystems and are now looking for ways to bring finance under that banner. Apple in particular has developed a very strong closed ecosystem with tight controls over hardware, software, and any third-party access to their services or devices. And in addition to this, the EU's PSD2 open banking requirements allow the integration of financial and banking details with many different services, which can enhance tech firms' existing payment offerings. If these companies can then offer a whole range of financial services within their ecosystem to comply with those regulations, and then it can promote a full service suite directly to users under its own brand, rather than allowing other firms the opportunity to fill out a proportion of that ecosystem that they could claim on their own. We are also seeing this driven by competitive pressures in some ways. The Apple Card is the first real example of this, which was brought out to encourage the use of Apple Pay just as the US banks start to roll out contactless cards. The mechanisms of the Apple Card incentivize the use of the phone for contactless payments, while the card covers the EMV and brings that within Apple's aegis. The success of Apple Card has been clear since November, when Goldman Sachs announced that Apple Card users had a collective $786 million in loans outstanding. And that success will only embolden other tech companies to connect their services to financial offerings. And in addition to this, the the open banking regulations just pretty much make that a much easier reality to bring about. But the regulatory requirements for becoming a bank, rather than just using banking services, will deter many tech companies from going all the way with financial services. And we expect to see far more in the way of partnerships between banks and tech companies, rather than tech companies outright striving to become banks. This gives banks an opportunity to bring about banking as a service offerings to interested tech companies, monetizing their systems and access to their systems, rather than their traditional stranglehold on data and payments access. We expect this to have a bigger impact in 2020 because there are already moves underway to have a higher level of cooperation in the space. Google has been in talks with Citi since November 2019, and PayPal's issued a Venmo credit card that October. However, these indications are that they will be more limited than Apple Card and will leverage existing banking arrangements within that partnership. These can be interpreted as small initial product launches to test the validity of the overall approach, and success in these deployments could result in much larger scale financial service offerings from these tech companies. However, it is worth noting that these vendors have a significantly more open ecosystem than Apple does. Apple Card has had an impact due to the highly closed nature of Apple's ecosystem, which is not true for most other vendors. And as such, these firms will have to offer more compelling products to differentiate themselves and make them worth using, which distinguish themselves from other digital-only brands as well as traditional players. And in this market, it is not enough to be new, and users require much more justification than that to go through the process of taking all their financial stuff and funneling it through an existing tech brand. With open banking having a huge impact on the financial space, particularly on the markets of North America and Europe, these rollouts will happen rapidly thanks to this flexible infrastructure. And by leveraging banking as a service models, tech firms will be able to deploy services without becoming encumbered with complicated regulatory challenges. However, we're not expecting all of the tech companies to benefit from this. While the Chinese model that WeChat and Alipay have used is based on social payments, Facebook Pay will not be operating in quite so much of a vacuum as those companies have, and will in fact suffer relative to other providers thanks to the negative reception of its Libra cryptocurrency. There's also been controversy around Amazon in certain markets, most notably India recently. And so trust has the potential to become a major hurdle in this area, which needs to be handled carefully for everyone involved as they press forward with bringing out more services. And now over to Susanna, who will bring in number 2 for us.
Thanks very much, James. So following the successful transition from Magstripe to EMV cards, so we believe the next area for significant growth in the US is for contactless payment cards. Now, the US is a quite unique market in that the migration from Magstripe to EMV has only recently happened at scale. To date, contactless card payments in the US have been just a fraction of those in other markets, such as the UK and also in China. So why do we think this is going to happen in 2020? Well, to begin with, the cost of issuing contactless cards has declined quite significantly as a result of major card issuers achieving economies of scale. Also, an increasing number of contactless enabled payment cards are being introduced by several major banks and credit card issuers. Visa has already conducted an extensive advertising campaign that's designed to raise awareness of contactless payment cards, and it set a goal of 300 million cards by the end of 2020. The belief is that where contactless payment cards are present, they're used, and that will lead to use out of habit. In addition, some of the major banks issuing contactless payment cards include Bank of America, Wells Fargo and Chase, and American Express and Discover are also issuing cards. Some of these players are even sending contactless enabled cards out to customers before the expiry of their current card. So as a consequence, as you'll see from the chart on the right, the number of contactless cards in issue in the US will see significant growth, and we see around 87% from 2019 to 2020, rising from 256 million cards in 2019 to almost 480 million in 2020. And this is going to reach over 1 billion by 2023. So who do we think will benefit? Well, contactless cards are a much quicker and easier method of payment than chip and PIN. And this means that both merchants and consumers will benefit from greater throughput of transactions at point of sale. The additional transaction time introduced with that transition to EMV from magstripe is again reduced through the use of contactless cards, and this will lead to an improved experience for cardholders. In addition, most merchants can already accept contactless payments. Many of the newer EMV-enabled point-of-sale terminals now in use are compatible with such payments, and they just require software installation or updates. And almost all of the point-of-sale terminal ranges available in the US now can be obtained with a contactless NFC reader. So what does Juniper Research see happening? Well, in terms of growth in transaction volumes, much of this is going to come from the use of unattended contactless terminals in the transport sector. Just to give you an example, New York has been accepting contactless payments on Staten Island buses and at subway stations in Manhattan and in Brooklyn. In fact, in November 2019, the Metropolitan Transportation Authority, the MTA, announced that its contactless fare payment system had exceeded 3 million taps. So given this success, the MTA plans to extend the availability of contactless payments throughout its network by 2020. So accordingly, transit systems in other major cities are likely to follow suit. And the US we're going to see rapid growth in the volume of contactless payments there in 2020. Over the next 3 or 4 years, the US will reach share of contactless payments that will be on par with other markets. Also, the rising adoption of contactless payment technology through services such as Apple Pay and Google Pay will also boost the adoption of contactless cards because consumer demand will drive retailers to embrace the technology. Given the transaction limit of contactless cards, it seems that they're probably most likely to displace cash payments, as well as being used for lower value card payments. Payment via contactless card rather than cash will offer additional benefits for merchants through increased transaction fee revenues. Also, in the US, there is still a pretty high share of consumers who prefer using physical cards over other contactless payment methods such as Apple Pay or Google Pay. The rising awareness of payment cards with contactless functionality and also the benefits of paying for small purchases amongst both merchants and consumers, as well as the increasing use in the transport sector, will mean that contactless cards will see strong growth in 2020. So now I'm going to hand back to Nick for our top fintech trend for 2020.
Great, thank you, Susanna. And now at number 1, without further ado, Juniper Research believes blockchain will disrupt international money transfer. So why is blockchain going to be so valuable in this area this year? Traditional money transfer solutions have been pretty problematic, and in both the B2B and P2P areas, plagued by slow transfer times and high costs. The clearing firms involved in the transactions have independent processing systems, and each party involved in that process will keep their own copy of that record of a given transaction. The lack of standardization between these bodies and correspondent banks means that costs are high and settlement periods are lengthy. Now, while blockchain is viewed as highly progressive and perhaps somewhat a little unreliable in other areas, in money transfer it has a high level of potential. Partly this is due to the basic concept of blockchain and how similar this is to the basic concept of money transfer on an international scale. The ecosystem of banks and other financial institutions involved in money transfer is a vast network, with transactions flowing across this. Blockchain is similar in that it's a large network of connected nodes. Given this similarity, blockchain deployment on the face of it can be a suitable replacement. So why is it going to emerge in 2020? Firstly, the products and the solutions have really initially fallen into place in 2019. We've seen important solutions emerge from 3 major players, and they are all starting to demonstrate the potential they have. Visa has launched B2B Connect, IBM has launched blockchain WorldWire and Ripple has launched RippleNet. Much has been made of comparisons between the services, but ultimately they're all fairly different. Visa B2B Connect has a tight B2B payments focus, while IBM Blockchain WorldWire is focused on using stable coins to enable a network. RippleNet, meanwhile, is based on its own cryptocurrency. These players have also announced a broad range of partnerships with money transfer vendors and other financial institutions, showing that momentum is just starting to build. Ripple boasts over 300 partners, including MoneyGram, SBI Remit, RIA, and Instagram. Visa B2B Connect has announced an integration with Infosys and has a broad set of contacts in the financial ecosystem. And IBM is also extremely well connected in the financial services area. Now, these have set up these players for dramatic growth in 2020. And in the context of instant payments, which we discussed earlier, money transfer vendors have to evolve if they wish to retain payment volumes. Blockchain offers them an efficient way to do this by adding them to existing networks which are increasingly well established. So we've discussed what these changes will be, but how are they going to benefit over the year and beyond? So firstly, these schemes are going to be of major benefit to the money transfer operators, and by that we mean traditional players like Western Union and MoneyGram. Traditional money transfer operators have long found themselves being challenged by new fintech startups in the market, like TransferWise, and this has left older operators struggling to offer equivalent digital services. By migrating these services to blockchain, these operators will be able to vastly improve them, increasing speed and transparency while reducing the overall level of cost. This will enable them to be better equipped to retain market share, and that's going to be highly valuable to them in the face of the competition they've struggled with. It will also likely lead to a consolidation in the money transfer space, as the ability to differentiate services is eroded by the implementation of standardized blockchain networks. The other main benefit will be to blockchain platform providers. Now, we hear a lot about blockchain and about the blockchain area, and there's been a huge amount of hype around it. We've seen a lot of pilot schemes in diverse verticals, but at some points it's been difficult to foresee a path to deployment of blockchain at scale. Providers such as IBM and R3 offer fully featured blockchain platforms for which practical deployments, such as in money transfer, are highly valuable as an example of how blockchain can be successfully implemented. And that's going to be hugely valuable in building momentum in other areas. And the last major beneficiary of the development will be users. Users will benefit from improved settlement times, a better user experience, but although this will be fairly marginal with the accompanying rise of instant payments, and faster transfer times will be a reality without blockchain. So how is this going to affect the market going forward? So firstly, we see blockchain becoming a viable technological solution in money transfer, which will gain traction. This means better services, and it will have that important network effect on blockchain, going a significant way to establishing blockchain as a viable technology. It will also show that there is substance to it beyond this hype. Secondly, money transfer operators will seek partnerships to ensure they retain market share in a changing environment. Blockchain networks will enable them to offer more competitive services at a lower cost, which enables them to fight back at fintechs who have been steadily eroding their margins. And these changes will enable cross-border B2B transactions via blockchain to grow massively over the next 4 years, exceeding $4 trillion in 2024. And for more information, please see our recent blockchain research, which is linked at the bottom of this slide. Now, that wraps up our top 10 fintech trends and predictions for 2020. And before we move on to any questions, let's just have a recap of the rankings, now ordered 1 to 10. So right at the top, we discussed how instant payment momentum will build, with international interoperability being key to that, as well as how the rebundling of bank services using open banking is going to happen. This was followed by Latin America emerging as a crucial payments battleground, as well as QR payments reaching scale in emerging markets. At number 6, we had challenger bank consolidation beginning, followed by 3D Secure 2.0 enforcing de facto SCA implementation. At number 4, we explained how Facebook Pay will gain momentum despite the reaction to Libra. And at number 3, we had tech firms moving farther into the banking area. At number 2 and 1, we discussed how contactless cards will reach scale in the US and how blockchain will disrupt international money transfer. So I can see, looking at the chat box, really the only question we've had is whether the presentation will be available after the webinar. That will be available, and there will be a full recording of this webinar uploaded to YouTube. So look out for that. Really, that brings us to the end of our FinTech webinar. We all hope that you found these trends insightful. This is just an overview of some of the different elements we cover here at Juniper. So feel free to reach out with any questions. As discussed, we're going to make a recording of this available on our YouTube channel, and the slides will also be available. Once again, please download any related reports from our website. And if you need any further assistance, you can contact us directly on the contact details provided here. Once again, thank you all for joining us. I hope this has been insightful, and we will speak to you soon. Thank you very much.